Hello and welcome to Gotstockz. Today we're going to be looking at the technical analysis for the Nasdaq 100 for key points of entry to help minimize risk and maximize profits to help build your perfect portfolio. I respect and appreciate your time, so let's get right into it. Today is Tuesday, March 4th, 2025. And the market's getting smoked again. The Nasdaq 100 is down 273. Dow Jones is down 776 and the S&P is down 100. This is pretty substantial meltdown. But what we're going to do is we're going to take a look at some of the technical analysis to see exactly where the market's going and what are some good key entry points. No one knows exactly when to get in. You're not going to get in at the very bottom, very rarely, occasionally maybe, and you're not going to sell at the very top. So it just depends on your style of what's going on and what you're doing. So let's take a look. When we look at the Nasdaq, we're going to pull up a chart here. This is a 20-year monthly chart. We've got, here's our COVID crash, right? And the market's in a bull phase. We've got a major correction here, a major correction here. This is our 2022 bear market. Primarily, for the past 20 years, the market's doing this. There's going to be a lot of sell-offs. There's going to be several crashes along the way. But if you're investing for the long haul, you want to invest in ETFs, the QQQ, the SPY, the VOO. There's many to choose from. These are going to give you a broad-based portfolio, balanced portfolio. For example, if you invest in the S&P 500, you're going to be investing in 500 stocks. If you invest in the QQQ, the NDX 100, you're going to be investing in the top 100 Nasdaq stocks. And that's what you want to do. For the long haul, you want to invest in the top premier companies. So don't be worried, because this is what's going on in the market. We're going to look at 5 years now on a weekly chart. This back here is our COVID crash. We hit a low of 67.71, went into a bull phase for 2 years, and then in 2022 we went into a bear market, and then from September of 2022 until now we've been in a bullish phase. So we can't get too worried about when the market does its correction, because it happens here, 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 and it's happening right now. What we want to do, we need to look at some percentage ratios to see exactly what is a potential good area to get in. We're going to zoom in on this area here on this bear market to see exactly what the drawdown was. When we go to a 5-year weekly chart, we're zooming in. The top of this week is going to give us a high of 16,764.86, and it looks like it hit a low here, which was the week in October, and it hit a low of 10,440.64. Let's pull up our percentage calculator, and we're going to type in 16,764. We're not going to count the change. 10,440. That was a decrease of 37%. That's a substantial drawdown. That is a serious, but we were in a bear market for approximately 9 months, and that's going to happen again. Is that going to happen now? Very well could happen. But if it does, you cannot panic. You just got to know that the market's going to recover and it's going to come back to all-time highs again. Let's get rid of this. Let's look at this drawdown. After we started our bullish phase in September, this is going to be a little bit of a pullback. January of 2023, we hit a high of 12,880, and it looks like we bottomed out at 11,695 March. Calculator. 12,880, and our drawdown 11,695. That drawdown was 9.20% decrease. From that point, we went back into a bullish phase. Let's take a look at this drawdown. Zoom in a little bit. So in July, reached a high of 15,932. Looked like we bottomed out in October with a low of 14,058. Keep in mind, this chart we're looking at, this is a weekly chart, so each candle represents a week. So sometimes these drawdowns, they can last several months. This drawdown is from July to October before we went back into our bullish phase. Here's the bottom, and then we went back into our bullish phase. This is our drawdown, and this is our bullish phase. So let's take a look. Get rid of that. 15,932, and then we are going to look at 14,058. 14,058. And we're going to calculate this drawdown was 11.76%. So our bear market was 37%. Now keep in mind, this is the Nasdaq 100. Very tech heavy. Tech heavy makes the most in a bull phase, and then in a bear phase, they get hit the most. Keep that in mind. Let's take a look at our next. From here, and here's our next drawdown. Takes time to do this stuff. This is going to give us some valuable information going forward when we look at this current drawdown, what's going on, because you can start dollar cost averaging in as these markets get decimated, because what happens is they get oversold and then the buyers come back in, the bulls take over, and we're off to the races again. And that's when you want to buy these stocks. You don't want to just jump in there. I see a lot of channels out there. They just tell you buy puts, buy calls, sell calls, and do it at the money and blah, blah. You know, be careful, because the market will serve up some humble pie. So let's take a look at this drawdown. Looks like a little bit of a drawdown, but got to do it. Looks like we have a high. This is March 18,464. And we hit a low in April. This was relatively quick drawdown of 16,973. Come over to our percentage calculator. 18,464. 16,973. 8% drawdown. I think we're starting to see a theme here. Now, one of the statistics that is standard in this industry that you'll hear a lot is that the market will have two 10% decreases throughout the year. And every 2 years, it'll give you a 20%. And then when you go into a bear market, that's typically every 5 to 8 years. So it's not an exact science, but this is just to give you some parameters to go by. We're starting to see a theme here. Let's get rid of this. And then from this point, we're off to the races again. Hit a high, and then boom, we're in another drawdown several months later. So let's get a little more granular here. We're going to look at this drawdown. We're coming in closer here. July hit a high of 20,690. Each candle is 1 week, and it hits a low in August. This was a 1 month drawdown. It's a low of 17,435. 20,690. Boom, 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 boom. 17,435. Keep the change. Calculate. Ooh, this was a doozy. This was 1573. So if you went with the average of 10%, well, you took another 5% haircut before this thing turned around. But this could have been part of our 2-year 20% drawdown that went down to 16%, right? Something to consider. Because from here to here, we're into our 2nd year, and this is our major drawdown. All the other drawdowns were 9.2%, 11.7%, 8%, and here we are, this drawdown is 15.73. So this could be that every 2-year, 20% range drawdown. So we've had that. But it can happen again. This isn't science. This is statistics. So this is what technical analysis is going to help you with. It's going to help you with your percentage ratio of possibilities. It's going to help you with your percentage ratio of probabilities, which is going to help your percentage ratio of profitability. Manage your risk. The key to success in this industry is to manage your risk. And that's what we're doing here. We're spending some time with technical analysis. We want to see what's going on with the market. We want to look for some key entry points. Thank you. If you're still with me, well, that's great. If not, well, good luck. We are going to look into from here. Boom, we've been in a bullish phase. We've been in a consolidation period here for several weeks, and then now we're into our drawdown. So let's take a look. Let's get a little bit more granular here with our drawdown. This is a weekly chart. Keep in mind, the high is 222.22, and the low is 20.034. 22.222. Imagine that. 20034. 10%. 9.84%. In 2022, it's come back out here. Right now, what we have is we're going to go over some of the numbers real quick. And the more time and the more due diligence you put into the process of analyzing the market and your stocks, your better percentage ratio of profitability. And that's what it's all about, because we want to survive these markets. And this is where people blow their accounts up and it's dangerous. It's not as easy as sell the put, buy the call, the wheel strategy, make 10 grand a day. You know, that's all a bunch of nonsense. Now, you will do it in a bull market, you will, but then these flash crashes and these consolidation periods and these drawdowns, that's where your weakness will be exposed, and you're going to get smoked, and your account is going to get wiped out if you're not positioned properly. You need a balanced portfolio, and it's the key to managing the risk in your portfolio. So now what we need to do is we're going to get a little more granular. First, we're going to go over the numbers just so you can get an idea. November of 2021 to October of 2022, the market hit a high in November of 16,764, and then in October of 2022, it hit a low of 10,440. That's a 37% drawdown in your account. Ouch. That's a bear market. Bear markets, you're going to be in the 30% range. And if you're in tech, you're going to be a little more than 30%. So now we're going to go to January of 2023. We hit a high of 12,880. And then in March of 2023, we hit a low of 11,695. So that particular drawdown there, well, it lasted 3 months. That was 9.2%. Remember, we talked about the market's going to retrace 10% range 2 times a year, 20% range once every 2 years. These are my opinions. These are facts. Read the books. Study the successful people in this industry. Don't trust anyone. Read the books. The next one is July of 2023. The market hit a high of 15,932. And then in October of 2023, it hit a low of 14,058. That's an 11.7% drawdown. 10% range. Imagine that. March of 2024, the Nasdaq hit a high of 18,464. And then in April of 2024, pretty quick drawdown. That was a scary one. Hit a low of 16,973 with a drawdown of 8%. Imagine that. There's that 10% we're talking about, right? So now in July of 2024, the market hit a high of 2690. So 20,690. And then in August of 2024, NASDAQ hit a low of 17,435. That's a drawdown of 15.73%. That's almost 16%. That's close to that 20% range we're talking about every 2 years. And if you look at the chart, we're into the second year. So this could have been our 20%. Nothing's perfect. This isn't a science. These are just possibilities, probabilities of statistics of stuff that has happened in the past. Going forward, will it happen? History tends to repeat itself. Here we are, February of 2025. The market hit a high of 22,222. Now in March of 2025, hit a low of 20,032, 9.84%. Now in individual stocks, you might be wiped out a lot more than 9 or 10%, but this is the overall average market. So now we're at close to that 10% drawdown. Is this going to push into that 20% drawdown? It could very well. Could it be our next bear market? Absolutely. But let's take a look at some key areas of support and resistance. We're going to look at some moving averages. And for long term, these are areas that you actually buy. You want to buy on these major drawdowns like this, because if history repeats itself, the market is going to eventually come out of this little drawdown and off to the races again. Okay, here we are. This is a 1 year daily chart, and the Nasdaq looks like it's trying to recover some. It hit a low, and now the bulls are coming back in. What you want to look at, you want to look for gaps. You see that big gap right there? Well, that gap is now considered filled. So this is good, because gaps tend to always get filled. Sometimes it's a week, sometimes it's a day, sometimes it's a month. It can be a year. But when the market or individual stocks start trading close to those gaps need to get filled. And anytime you see the market gap up substantially, like here, it pulls back, it didn't fill the gap, and everybody got all excited, only to bam, come back and fill this gap. When I see big market gap ups, that's good for trading. You can trade that, you can make some money doing that. But as far as for investing, cannot invest at that point because the market is going to come back. So now what we want to look at is we are going to pull up our moving averages. The white line is the 10-day, the purple line is the 21-day, the green line is the 50-day, the orange line is the 100-day, and the red line is the 200-day moving average. These are key important areas that institutions, hedge fund managers, they set a lot of buy points at these moving averages. So when the market does pull back and fill that gap, imagine that happens time and time and time and time and time again. You can set your order entries and just go play golf. And it might be a month, could be 2 months. That gap's going to get filled. You're buying the market at the right time. Where are we now? Where do we want to get in at? This area here, we're going to zoom in across. And imagine that the market came down and touched the 200-day moving average, and the bulls came in and are buying the market up right now. Is this an entry point? Absolutely. I'm going to be purchasing, I'm going to be selling some options on the market today at this particular point. We're at a close to a 10% drawdown range. Can it go further? Absolutely. But I'm not looking to trade for a day or two. I'm looking for long term. And then also I like to swing trade, channel trade, moving average trade. We're into the 200-day on this indice. So where is it going? We want to set some support and resistance levels. We have a low of 18,400. That's going to be support. Down here, this is going to be support also. It's going to be our first stop. So let's come to here. The low is 19,880. This is going to give us a level of support, and this is 19,622. Here's what's concerning. These are levels of support. Okay, this is definitely a level of entry, but also what we want to be concerned about is this gap was never filled. So on September 18th, the market closed at 19,344 and change. The next day, it opened at 19,798, and it never filled this gap. This gap will eventually get filled. Will it be on the next bear market? That's a year, 2 years from now? Very well could be. Or the market might not be done with its retracement now, and this could be a 20% retracement. You dollar cost average. You can start buying into the market now, which is what I'm going to be doing. And then also, if it continues to go to the downside, well, you dollar cost average. You don't load up and you don't go all in. That is one of the biggest mistakes that people make, and I still make it to this day, 25 years later, is you go all in. Your positioning size is way too large. 90% of traders, day traders, fail. They blow their accounts up. And the other 10%, they fail also. They've blown their account up several times. But they survived on the other end because they learned to respect the process, to respect the market, position sizing, managing risk. These are the keys to success to the stock market. I hope this was helpful. I'm going to put a couple of links below in the description. Tasty Trade, Schwab, Fidelity, Robinhood. These are some professional trading platforms that you can go to start your account so you can start trading today. But you want to trade in a simulator. I know with Thinkorswim, they do have a simulator so you can learn how to trade on a trading simulator, then go and start trading with real money. You can do this. I appreciate your time. The moral to the story is put your trust in yourself. Do your own due diligence. And you need to respect the process. Study the successful people in the industry. Thank you for tuning in. I hope this was helpful for you. Subscribe to the channel, hit the like, notification so we can keep you informed of how to manage these risky markets. Always do your own due diligence, and the more time you put into it, the more you're going to get out of it. So always remember to dot your I's, cross your T's, and don't forget the Z. God bless and happy investing.